Hi, I'm Theo Sharp. I'm a Managing Director at Meyer and Partners. I'd like to welcome you to this short webcast regarding some of the issues that we see in executive compensation in life science firms. Here's a short agenda of what we'd like to accomplish during this webcast. I'd like you to come away really with an understanding of, one, who Meyer and Partners is as a firm, and more specifically, who Shaker and I are as compensation consultants. We'd also like to talk about how total rewards, and more specifically compensation, fit into the life cycle of a life sciences company. Then I'll talk a few minutes about how we see corporate governance and executive and director compensation evolve over the course of a company's life cycle, and then a couple quick notes on how pay and performance might be linked in life science firms, which is frankly one of the toughest problems to crack as a firm grows. We're the largest independent compensation consulting firm by most measures in the country. We're consistently recognized as a leader in both executive and director compensation. And our mission is to design compensation plans that are tailored to fit each of our clients' specific situations rather than sort of recycle the last plan that we did. A few more specifics on this point. Our independence. Our practice is solely focused in the area of compensation. We don't do benefits, deferred compensation, funding, insurance, or audit. We only do compensation. And by focusing on this, it's really a critical area of human resources, we're able to provide our clients with really high quality and most importantly, objective and independent expertise, unaffected by what else we might be able to sell you. So we have scale. We're the largest, as I mentioned, we're the largest executive compensation firm in the country, which allows us to have a dedicated national technical and regulatory support team. And we have many accountants, statisticians, HR experts, and lawyers really on staff, as well as 2 law firms and an accounting firm on retainer if we need to draw on those resources. In addition, our scale means that the urgent needs of our clients can be met. No matter what the deadline might be, we can get the project done. Our scale also offers us another advantage, and that is our essentially collective experience between our more than 25 partners. Next is our customization. Every project we do, and each recommendation is individually tailored to the business strategy, goals, and specific needs of each of our clients. Its directors, its management group, its owners all have a say in how the project is done. We're able to do this by going through an exhaustive foundation building process with all of our new clients. It allows us to get to know the businesses, the people, and the industries that we'll be serving. Really, we like to be trusted advisors. We serve a select number of valued clients with whom we establish long-term relationships as a trusted advisor. Our goal is quality execution based on that relationship. A little about Shaker and I. I'm Theo Sharp. I'm an attorney by training, but I've been sort of knee-deep in this field of compensation for more than 15 years. Started my career at Arthur Andersen, back when it was named Arthur Andersen, and finally ended at Meyer and Partners about 8 years ago. And that's when I realized that there was only one way I could really provide objective advice to my clients, and that was if I was part of an independent firm rather than attached to other service lines like audit. I've worked with life science, technology companies, sort of all sizes and stages of development over the course of my career, and I've experiences in sort of all facets of the arena, which is benchmarking, deferred compensation, golden parachutes, IPOs. Through the course of my career, I've handled various situations like this for all of my clients. Shaker will be joining us at the conference, and like me, Shaker has deep experience in compensation, but I'd like to point out also that he has a very deep knowledge of international compensation, which is very helpful to many of our clients. Now, I won't spend much time on this slide because I've talked a bit about this earlier. But what we've done here is broken down what we do into sort of bite-sized bits. We service executive compensation needs, director compensation needs, and we help companies establish and maintain compensation governance processes that support the good decision-making in the compensation arena. With each of these areas, we support our clients by trying to get them the right answers in order to fairly compensate executives and directors in the correct manner that supports business in all facets, from the financial area to regulatory compliance. Now, I mentioned our expertise in compensation and alluded to our industry expertise. I'd like here just to reiterate the latter point. compensation varies really greatly in amount and mix from industry to industry. So it's important to know the industry. Its customs, its needs, and its people really affect the way we view compensation and the way compensation should be viewed by a company. In fact, we have a dedicated team now that is dedicated to the life science industry. Here you can see some of our content that we generate, and it can be helpful to both our clients and non-clients. I'd encourage you, frankly, to go to the website we reference in the third bullet there and sort of explore what we have for both our clients and non-clients on there. Now, quickly, the obligatory look at all our clients slide. What I'd like to point out here, though, is the breadth of our clients, from small private companies, small public companies, to large multinational. We have this type of client base is how we gain our experience and keep up with industry changes that we can then apply in our day-to-day practice. Let's move on now to just a bit about our perspective on compensation. At the forefront is the thought that business needs to evolve their compensation models as their businesses mature and go through the typical stages of corporate life. Here you can see business school, frankly, business school definitions or examples of the three major stages of the corporate life cycle. Through each of these stages, there are sub-stages, of course, but for our purposes, we apply these major demarcations and note generally how compensation must evolve as the company does. The next couple pages that we're going to go through here just show each stage at the top and each element of compensation down the left side there. And I want you to know how each element of compensation changes from left to right, from startup to maturity. Each change supports the then applicable needs of the business. For example, startups need to conserve cash. There's more than one reason for this. I mean, sure, cash is a scarce commodity, and it's very hard work to go out and find the cash, and that takes away from advancing the science. But also, the people that you get the cash from, the investors, demand return, and transferring their cash to employee bank accounts is often not seen by those people as a smart return on their investment. As a result, we see low salaries on the left here and increasing salaries to the right as the business matures and it begins generating its own cash. Now, similarly, with annual bonuses, you'll see those as less frequent on the left, and they gain prominence moving to the right with corporate maturity. So companies don't want to commit to pay cash when it's scarce, and bonuses are less formal, more opportunistic at that time until cash is being generated. Even then, the focus on bonus metrics needs to change. They typically go from milestones, which can be filing of NDAs or completion of studies, to the financial stability of the company as the company implements these formal plans and changes the stages of the life cycle. Now, probably the most talked about piece of compensation, as most know, is equity, or as we call it here, the long-term incentive. You can note on the left the prominence of LTI in the early stages. This is for a few reasons. First, to offset the low cash, but it also recognizes that employees want to share more in the upside of the scientific advancement through a piece of the enterprise rather than just getting a paycheck. Further, right, it helps offset the risk that employees take when they leave larger, more stable companies for the entrepreneurial enterprise. It helps focus on the long-term viability and growth of the company through the life cycle of the business when the individuals are getting that piece of equity. The importance of the LTI and the equity gets lower. Obviously, the company moves to the right, and the professional management is hired that demand, to be honest, much higher cash burn rate on a personal side, so they're going to need more cash from their day-to-day job as opposed to the equity. That's not to say the equity goes away. It still remains an important piece of the long-term compensation of each individual at technology and life science companies. Now, similar to base salary and other cash compensations you see on the bottom there, the benefits are sort of de-emphasized early, and mainly because they tend to be cash intensive, but tend to gain importance on the right as the cash becomes more, the companies become more cash rich. Now, those are a few of the concepts on the exec comp. If we want to move just for a minute to the corporate governance. Now, I know this is just a little tough to see probably, but again, as we move from the stage of development on the left being the startup, the early phase, to the right, which we define here, frankly, as the post-offering or post-IPO, but can also be seen as just corporate maturity. You'll see the theme being less formality, both with regard to the way the board interacts with management, the way decisions are made, and the way compensation is determined. To the right, as things become a little more formalized. So at the beginning, if you look at the middle there, the compensation committee, at the beginning there's no separate compensation committee. But as the market tends to validate the science that's being done by the company, a separate compensation committee is established and some more formal compensation guidelines are put in place. Where finally, just prior to an offering or maybe a merger or maybe even a partnership that's going to generate cash for the company, a separate compensation committee is defined, and their charter is established, and formal guidelines are put in place. And then we have formal, even a more formal committee put in place after an IPO or once the company starts generating large cash, which then has a very specific charter and has much more governance by independent directors over the executive compensation and the director compensation of the company. Now that applies to not only the compensation committee, but frankly to the focus of the directors themselves, from managing their investment, which is typically the non-independent director at the beginning, to corporate governance in general on the far right. Now if we look at director compensation, I won't spend much time on it, but it follows the same route as executive compensation, which is to say that where you have in the early stages mainly just professional investors on the board, and they're managing their investment, protecting their investment, and overseeing the direction of the company, to a situation with mature companies where either other shareholders have generally come into play or public shareholders have come into play. And the job of that individual is going to be much more corporate governance, representing those other investors, and as such are paid more for that function. So at the beginning you'll have no cash compensation in general. You'll have only some equity compensation to where you have more investors or public investors. The directors are actually being paid a very formal cash retainer, are on committees and being paid for committees, and receiving generally equity grants in their corporate governance roles, as opposed to just a role where they protect their investment in the smaller company. So again, this goes through the next stage of director compensation. I won't spend a lot of time here because I did talk about the direction of director compensation, but you'll see here as we go through the post-offering period, if you look at the cash compensation in particular on the bottom, you can see that as the life cycle of the company goes towards maturity, more emphasis is paid on cash compensation to directors as opposed to equity compensation. Now, in summary, this is our sort of reference chart for the progression of executive compensation from the startup phase through the post-offering phase. It essentially goes through what I went through in detail in the earlier chart, but this again is our quick reference that you can print out and see the progression from informal, no cash, to more formalized cash guidelines and even equity guidelines in the either post-offering phase or the mature phase of the company. Now, I wanted to spend just a second on one of the hottest topics in executive compensation, particularly for public companies, and that is pay for performance. And this chart shows an example of the correlation of various financial measures to the total shareholder return of a company. And this conceptually applies not only to life science companies, but to corporate entities in general. And the purpose of this is merely to show that what the goal is to find a metric that relates very strongly to total shareholder return, or the return on investment to investors, and to be able to focus the compensation payouts for executives, not necessarily directors, but executives, on those particular metrics that will in fact translate into a better return for investors. So you'll see here that over, for example, over a period of time, EBITDA growth, in fact, has the highest correlation to total shareholder return. But interestingly, you do have some cash flow measures, sales growth, earnings growth, or net income that correlate greatly there. So what you'd want to do is take over the long-term plans. You'll see the larger blue bars are the 5-year measures, correlate strongly. So those are metrics you'd like to focus on for a long-term compensation plan for executives. And so this goes through just, you can see in the short term that net income growth exhibits the highest correlation, whereas in the long term, you'll see that earnings growth in general, EBITDA growth, show this strong relationship to the performance of the company. Now, specifically to biotech and pharma, you'll see that return on some of the balance sheet metrics in the short term are really the focus. Now, this goes towards more the mature companies. If we look more towards the specific the companies that are developing drugs as we go, that are filing NDAs and such, very often you will find milestone-based metrics and strategic metrics, as we call them, as opposed to financial metrics based in plans. Those, as the company matures, necessarily, as I mentioned earlier, those metrics need to move to more financial metrics, and these show the correlation of the financial metrics to total shareholder return. So you'll see in the short term, the return on equity exhibits some correlation to the actual enterprise value of the company, where in the long term, the gross margin does. And that's a pretty typical flow from your early on return on equity to a much more income statement-based metric. So those are our initial thoughts on executive compensation. We wanted to give you just a preview of who we are and how we approach compensation, particularly in the life sciences industry. If you'd like to get in touch with us, you'll see here both Shaker and my direct dials and our emails. Thanks very much for listening, and we hope to see you in February.